bringing Willamette to you. I'm Kathy Gaskin, Director of Development for Gift Planning here at Willamette, and we're joined by Allison Bauer, who is our Director of Development at the College of Law. And we are both very excited to introduce our speaker tonight, Jeff Thede. He's class of 1979 of the College of Law. It's a family affair. His daughter, Justine, is a 2013 grad and works with her dad at the firm, and his son, Karsten, will graduate from our AGSM program in 2021, so next spring. He also just welcomed a granddaughter who we, if all goes as planned, will welcome and graduate from the class of 2045 from the law school. And she'll join granddad and mom at the firm, carrying on in the family business. So Jeff began his legal career with Miller Nash in '79 and remained there until December of 2007, when he helped form Thede, Culpepper, Munro, and Silliman. Jeff's practice emphasizes estate planning and estate and trust planning and administration, charitable planning, and tax-exempt organizations. So again, we want to thank everybody for attending tonight. We know you are here because you are generous with your time and treasure with multiple charities, including Willamette. And this is, like I said, going to be a very informal chat, so please do jump in with questions. So Jeff, where do you want to start?
Well, I just want to thank you and Tiffany and Allison for this opportunity. And thanks for assuming that I'll still be alive and kicking and practicing when my brand new granddaughter is practicing. I have a confession to make. My wife, Jane, and I had a case of cabin fever and we escaped. So I am actually in a condominium in Palm Springs. I've been relegated to the back bedroom. My PC is a borrowed PC sitting on a shoebox, sitting on a rickety card table, and hopefully it won't all fall down. But I think this will be fun. Hopefully lots of questions, lots of chats.
Jeff, let's start with the basics. Why are taxes important when you're talking about charitable giving?
Well, when you look at charitable giving, I think the keystone is the fact that currently under federal law, charitable gifts are income tax deductible. And I guess that's a matter of policy. It's sort of a governmental subsidy, if you will. You could argue either side from that from a policy standpoint. One, clearly it promotes charitable giving. Other folks might say, why should I, as a taxpayer, subsidize sort of what your goals are? But nevertheless, it is a subsidy. For example, let's assume a donor makes a gift of $100,000, and let's assume a combined federal and Oregon income tax rate of 45%. Tax savings is $45,000. So the net cost to the donor is $55,000. I like to take a more altruistic view of that, though. So if that same donor can afford to lose $100,000, then because of the deduction, the donor can make a gift of $180,000. Tax savings $80,000, cost $100,000. And so in that example, the donor has leveraged the benefits of the tax savings to increase the amount of the charitable gift. You can make charitable gifts, obviously, during lifetime or at death. The overwhelming majority of charitable gifts are lifetime gifts. Almost always better to make a lifetime charitable gift than a gift at death. Why is that? Because if a person makes a charitable gift at death through a will or a trust or a life insurance policy or an IRA, nobody gets an income tax deduction. The charitable gift is out of the donor's estate for estate tax purposes, but the estate does not get a deduction. Much better in that case for the donor, if possible, to make that gift during lifetime, take the income tax charitable deduction, and the property is still out of the estate.
So let's talk about some of the benefits of making a gift with an asset other than cash. We can start with appreciated securities.
When a donor is looking at what asset is best to give, a gift obviously can be made of cash, but better to make a gift of appreciated property. The general rule is that if a donor makes a charitable gift of appreciated assets like highly appreciated IBM stock, the donor gets a full fair market value deduction, and nobody ever pays any capital gains tax on that capital gain. The donor gets a deduction generally equal to the fair market value of the asset and generally deductible up to 30% of that donor's adjusted gross income. For example, let's assume a gift of $100,000 of IBM stock with an income tax basis of $20,000. Let's assume the donor's in a 45% income tax bracket. And to make my life easy, let's assume a 25% capital gains tax rate. So in that example, with the $100,000 gift of IBM stock, the income tax deduction is $100,000. The income tax savings at a 45% bracket is $45,000. The capital gains tax savings, assuming that the property would otherwise be sold, is $20,000. And so looking at it this way, the net cost to the donor is $35,000. Again, it's all about leverage. So what in this case, let's assume the donor likes that $100,000 of IBM stock and says, well, I've got $100,000 in cash. Why don't I keep my stock and give you the $100,000 in cash? My answer would be no. Better to do a wash gift. Go ahead and contribute your $100,000 of highly appreciated IBM stock. Take your $100,000 in cash, go buy $100,000 of IBM stock. You're right where you started, except now your income tax basis in your newly acquired $100,000 of IBM stock is $100,000. Now, it works both ways. So in the case of a gift of appreciated assets, the donor's income tax deduction is fair market value, even if the basis is much less, or even if the basis is much more. So let's assume this donor has $100,000 of IBM stock with a basis of $200,000, which is not realistic, I realize. Do you give that $100,000 of depreciated stock? No, you sell it. You realize the loss. You take the $100,000 in proceeds and make a gift of cash.
You want to talk about IRAs?
I would love to talk about IRAs. So y'all may have noticed there have been some tax law changes in the past few years. We had the Secure Act 2 years ago. We had the CARES Act. And there's a whole lot of chatter now about what in the world is going to happen under the tax code with the Biden administration. Nobody really knows what's going to happen, but in my world, here we are in December 2020, working with a lot of clients with a lot of concern about what's going to happen and what they can do. There is talk of reducing what is currently a lifetime gift and estate tax exemption of about $11,560,000, perhaps cutting it in half, because remember, 2 years ago, it was half, and in the 2017 acts, it was doubled. There's talk of either reducing it in half, or if you hear some of the Biden proposals, there's talk of reducing it from $11,560,000 back to $3,500,000, which would be huge. I have a lot of clients, non-charitable clients, who are exploring strategies to lock up the use of that exemption this month because it might go down. We don't know if it'll go down. I think it's unlikely that these major tax law changes will happen unless the Democrats can flip the Senate. So who knows what's going to happen, but that's one. There's also talk of, and I would hate this, of abolishing what is the stepped up income tax basis. So right now, if a person dies, all of the assets of that person's estate get a new income tax basis stepped up to fair market value at date of death. What does that mean? That means the beneficiaries can sell the asset with little or no capital gain. The talk is that that will be abolished in favor of what's called carryover basis, which means if you inherit appreciated assets from a dead person, you take over that very low basis on the appreciated asset. We can all argue whether that makes policy sense or not. I don't think it does. I'm hoping that rational minds will win because it would be an administrative nightmare. I'm old enough now to remember twice when for a short period of time we had carryover basis. It was a disaster. A whole lot of people have no idea what their income tax basis and their assets might be. There's talk of dramatically increasing the capital gains tax rate, and there's talk of a surtax for the ultra rich. I don't know what that ultra rich would be. Some proposals on the left, I'd be considered ultra rich. My wife doesn't consider me ultra rich. But there are some surtax proposals. We don't know what's going to happen. The good news, though, is none of these proposals, in my view, has a huge impact on charitable giving generally, and particularly with respect to whether things have to happen this month. So that was a long-winded answer to your question. Let me go back to what you really asked. So IRAs and retirement accounts are interesting assets for a couple of reasons. If a person with a large estate passes away with a large retirement account, that account can be subject to estate tax. And then when the beneficiaries of the retirement account receive the assets, it's dollar for dollar taxable income. Technically, under the tax code, that's called income in respect of the decedent. But what it means as a practical matter is no stepped up basis. So I'm going to actually, Kathy, answer your questions backwards based on your outline, and look at what happens if a person makes a charitable gift of an IRA account at death. That is a great asset because, so let's assume a person has $1 million IRA account and $1 million in cash or securities. If the IRA goes to the family, there may or may not be an estate tax, but the beneficiaries receive fully taxable income. If that donor in that example is charitably inclined, better to give the IRA to charity and the other assets to the beneficiaries, because the charity is exempt from tax and doesn't care if it's all ordinary income. Going back to some opportunities right now, for many years, there has been something called it's got different terms. Let's call it a qualified charitable distribution. So under the old rules, if I have an IRA account and I'm at least 59 and a half, so that I can make a withdrawal from my IRA, I could take money out of my IRA, $100,000, and I could give it to charity. I get a $100,000 deduction. And if I can fully use the deduction, and if there aren't any cut downs, as there tend to be year to year to year with the alternative minimum tax and the 2% minimum, at best it's a wash. With a qualified charitable distribution, if the owner of the account is at least age 70 and a half, the donor can contribute directly from the IRA to charity up to $100,000 a year. The withdrawal is non-taxable, the gift is non-deductible, but there's no net increase in income to that person. It's great for somebody who doesn't itemize, right? Because you're going to get the full benefit of that deduction. So the Secure Act 2 years ago made a couple of changes. One is the required minimum distribution rule used to kick in right after the owner returned 70 and a half. Now it's 72. For purposes of the qualified charitable distribution, a donor can do that if at least 70 and a half. So that makes a lot of sense. Now, the CARES Act, you may remember, was passed several months ago in response to the COVID crisis. And one of the many changes was required minimum distributions have been abolished for this year. So nobody needs to do that.
They still could make a gift, a QCD, and they will still it'll still pull out of their adjusted gross income for this year.
That's exactly right. So even though the owner of a retirement account can make a QCD to satisfy the required minimum distribution, even if in this unusual year, there is no required minimum distribution, the person can still do that. So Kathy's on the charity side. I'm looking more on the donor side, and she has some bullet points, one of which says, let charity know your gift is coming from the IRA for special receipt. Well, you can explain what that means, but I've got a different perspective, and that is if the owner of a retirement account, like the owner of a life insurance policy, intends to make a substantial charitable gift, and if that owner has in mind any restrictions or conditions, you need to document that someplace else, because those restrictions are not going to be shown in the boilerplate beneficiary designation. I'm working on a case that came up yesterday where a woman designated charity of about a $900,000 account. Her intention was to use that to fund a $1 million professorship at a medical organization in Oregon. She signs the beneficiary designation. Some years go by. She funds the professorship with $1 million, and then she died. So now there's another $900,000 going that was intended to fund the professorship. And the family is saying, but wait a minute, we funded the professorship. And the charity is saying, but we don't have any evidence of this. So, in addition to receipt issues, if you're going to make a large charitable gift that you intend to be subject to some condition, document that condition separately. So it's clear that when this IRA asset or a life insurance asset pours in, it's to satisfy that obligation.
So let's push on that a little bit further. Let's talk about if you specifically want your gift endowed when it comes upon your death. You need to have some language, some very specific language in there.
Right. I think that's exactly right. And now we're talking a matter of practice. My practice, whether I'm representing the donor or the charity, would be to prepare some kind of a fund agreement confirming that the donor wishes to create a charitable fund, in your example, a permanent or endowed fund for whatever the purposes are, where it's clear that not only the initial gift, if any, when that fund agreement is signed, but any additions later are subject to the same conditions. So I set up an endowment fund at Willamette, and it's called I'll use my granddaughter, the Avery Brook Occupancy Endowed Scholarship Fund, and I fund it with $1,280. But then I changed my IRA beneficiary designation to add money to Willamette to be added to the Avery Brook Occupancy Fund. That makes it clear.
Thank you. So we have some questions. What if you want to pass more than $1 million to your children? Can you gift the IRA to create an annuity or trust that gives income to children for a period of time?
Yes, you can. Do we want to go there, or do we want to do that in 15 minutes after we talk about those issues? But yes, you can do that. There are ways to do that, most notably including something called a charitable remainder trust. And it is perfectly fine to fund or augment a charitable remainder trust with a distribution from a retirement account or a life insurance policy. Got to help me here. Do you want me to dig deeper on this now?
Nope.
Or
that's just a tease. So
okay.
Then let's go to the next one.
My answer was yes.
Yes.
Let the record reflect. My answer was yes.
Okay. Second question. Can you gift an IRA to one charity and ask them to distribute some of it to other charities?
Yes, you can, but that's a terrible idea. Because the question is, what kind of relationship are you putting that charity in? Are you creating some sort of a trust relationship? Is it an agency relationship? Is it a moral obligation? You can't really condition the gift on it. So if somebody, wild example, $1 million to one organization with a side letter that says, hey, I'd really appreciate it if you'd give $800,000 to this organization. Donee organization gets the $1 million, and then the policy issue is, well, is that really what the donor wanted? Am I really in a position of turning the money over? So I would say much, much better to do a specific tailored beneficiary designation listing all the charities. And when you do that, it's critical for that donor and all of the advisors for that donor to constantly remind her what those beneficiary designations are, because two things happen all the time. One is, as I alluded to earlier, yeah, I really promised to give $50,000 to the Humane Society when I die. So that's in my IRA beneficiary designation. And then I said, hey, you know what? I've had a good year. I'm going to give the $50,000 right now. Never even thinking about the fact that there's going to be another 50 going in. So that's one. And the other is people forget. So I have clients contact me to update wills and trusts after a year, 5 years, 10 years, 20 years. I've had a couple of contacts recently because of COVID, because people are at home with nothing to do except think about stuff, about updating their wills and trusts. I've had contacts from clients I haven't thought about in 25 years. Well, as out of date that client's will or trust will be by definition, that client's beneficiary designations, if they name charity, are going to be way more out of date. So it got to stay on top.
And Jeff, typically when you're doing a beneficiary designation and naming multiple charities, it's going to be in the form of percentages, not a dollar amount probably, although it depends on the administrator.
It depends. I just worked with a client a couple of weeks ago updating hers, and she had in mind some charitable pledges to fulfill. And and it's a substantial IRA. She has a series of dollar amounts to charity, and then the balance is divided among family members. So it just depends on what the goal is.
Is it best to give specific stock, property, retirement accounts to a charitable organization, or designate a specific amount of money or percentage from the estate?
I would say rarely does it make sense to designate a specific asset to charity. Charities are tax exempt. Assets are fungible. They're going to be liquidated. It's going to be reduced to cash. So generally, that's not a good idea. Dollar amounts can be important if the person is in effect fulfilling a pledge. Otherwise, I'm a big fan of percentages because, what is it? The rising tide floats all boats. And when the tide goes out, the same thing happens. And so it fits a lot better. The other problem I have with, I can go off on 20 sidebars here, but the other problem with some of those specific designations of assets is if a person has a will or a trust or a designation that carves off this asset, this asset, this asset, this asset, a couple of questions come up. What if the will gives away substantially all the assets with the result that there's nothing left? There's no residue. There's no residuary estate from which normally you pay debts, expenses, and taxes. That's a problem. The other is, what if that person becomes incapacitated? So I had a case years ago where a woman had a whole bunch of accounts and she did transfer on death or pay on death designations, this account to this charity, this account to this charity, this account to this charity, balance to my stepkids. She became incapacitated. I have to be careful here. I think Willamette was in there. She became incapacitated and her stepson was appointed as conservator and didn't know anything about the POD. So what did he closed all the accounts and he put it into a new account. So she died, there were no PODs, and this huge estate just went to the stepkids. So no, I wouldn't use POD designations. I would avoid gifts of specific assets. I would avoid, if practicable, dollar amounts, and I would use percentages.
With the caveat that make the charity the beneficiary designation of your IRA. Everything else goes through your estate or your trust.
If you're looking at regular assets, IRA assets, and you have a charitable intent, yes, it is best for, not the charity, it is best for the family to shove all those ordinary income assets to charity and give the good assets to family.
So we've covered a lot of territory on the IRAs. Let's do this is going to be a quick answer. Would you recommend making a charity the beneficiary of a life insurance policy?
Well, this was in your outline, and I changed your outline and I put in no.
I know. And why?
Rarely does that make sense. The only case where that would make sense is if a person wanted to make substantial charitable gifts beyond the means of the person, but could afford to buy life insurance. Then maybe it makes sense to say, okay, I'm going to buy this policy for $500,000 and I'm going to provide for my 5 favorite charities. That would be fine, kind of an earmarking. In most cases, though, probably better just to, use normal assets of the estate. So, it depends on the circumstances, but I rarely work with a client for whom it makes sense to give life insurance to charity, unless it's an earmarking.
So we kind of touched on this, including a gift to charity in your will or trust. You can do a percentage or a dollar amount. The donors need to communicate with their charity what their wishes so that we can both honor their wishes. If they want an endowed fund, that we make sure it's documented so we can do that for them. And also that we can celebrate. We want to be able to celebrate their gift during their lifetime. Let's see. So let's talk a little bit about life income gifts. Jeff, what would you say is kind of the basic benefit of a life income gift?
the simple world of charitable giving, we all understand. You can make a lifetime gift of cash or appreciated assets, and you can use retirement accounts. There's a whole world of split income gifts, which are really unique under the Internal Revenue Code because they, among other things, give an opportunity to the donor to make a charitable gift, retaining some kind of benefit, whether it's life income or something else. And because of these unique provisions in the Internal Revenue Code, getting an upfront income tax charitable deduction. There are a variety of vehicles, some common, some obtuse. The most common would be charitable gift annuities and charitable remainder trusts. They are remarkable under the tax code, and I think I'm going to switch around what we talked about and talk maybe first about charitable remainder trusts. So a charitable remainder trust is a real life trust created during lifetime that provides for payments during the lifetime of the donor or others, or for a term of years, which further provides that at the end of the non-charitable term, whether it's the death of the donor or the designated beneficiary or the term of years, remaining assets go to charity. The donor can even retain the power in the trust to change who that charitable remainder beneficiary will be. What's unusual about these is when a donor funds a charitable remainder trust, the donor gets an upfront income tax charitable deduction for the net present value of the charitable remainder interest. And that net present value is calculated on the basis of two things. One is the term of the trust, whether it's lifetime or lifetimes or a term of years. And the other is the assumed interest rate prescribed by the Internal Revenue Service, which changes monthly. So you get an upfront deduction. Another great reason or great benefit of these is that the charitable remainder trust, as an entity, is exempt from income tax. So it provides a great opportunity for tax-free diversification. So I'll move this up a little bit. Let's assume a gift of $500,000 of Microsoft stock paying little, if any, dividend with a low basis. If a person makes a transfer of that to a charitable remainder trust and, for example, retains life income of some kind, that stock can immediately be sold and reinvested in a diversified portfolio. The charitable remainder trust is exempt from income tax. The donor gets an upfront deduction. There's two types of charitable remainder trusts. One is called a charitable remainder unitrust. With a unitrust, a stated percentage of the fair market value of the assets is distributable every year to the non-charitable beneficiaries for the term of the trust, and the remaining assets at the end go to charity. Since that's a stated percentage of the value of the trust assets revalued annually, that 5% amount goes up and down with the value of the trust assets. The minimum is 5%. The other kind of charitable remainder trust is a charitable remainder annuity trust. That too pays a fixed percentage to the designated beneficiaries, but that is a fixed percentage of the value at the time the trust is created. So it's fixed. So you have a charitable remainder unitrust, which pays a percentage payout every year to the beneficiaries, which rises and falls with the value of the assets, or a charitable remainder annuity trust, which is fixed. So
let's talk about that. Why would you lean one way or the other? What would be the benefit of one or the other?
Well, the benefit of I'm an optimist. The benefit of a charitable remainder trust is that if over time, keeping in mind that this is a tax-exempt trust, so the investment yield is not reduced by taxes every year. If over time the value of the trust assets increases, so does the annual percentage unitrust payment. With the charitable remainder annuity trust, it's fixed. Now, I don't mean to throw too much cold water on these wonderful vehicles, but I mentioned earlier that when a charitable remainder trust is funded, which is to say when a donor transfers assets into the charitable remainder trust, the donor gets an income tax deduction for the net present value of that down the road remainder interest based upon, number one, the term of the trust, whether it's fixed term of years or lifetimes, and number two, the assumed interest rate prescribed by the IRS. Now, I'm old enough to remember when this, it's called the 75/20 rate, was 8.5%, 9.5%, 10%. Well, particularly post-COVID, with interest rates plummeting, for the last 2 months, this interest rate was the all-time low, which was 0.4%. This month, it is raised up to 0.6%. The lower the assumed interest rate, the lower the calculated remainder interest in a unitrust, and therefore the lower income tax charitable deduction. So purely from a number crunching standpoint, with these low interest rates, charitable remainder unitrusts are not as glamorous, if you will, as they were before. I mean, they can still be great. You get tax-free diversification, upfront deduction, life income, but the deduction is smaller because of these very, very, very low assumed interest rates.
So let's say right now the deduction is smaller, but then over time, the interest rates go back up, the 75/20 rates go back up. Over time, that income, there's a lot of room for growth. If the interest rates go back up, there's a lot of room for growth of the corpus and the trust.
There is, but it's a little apples and oranges. And so the 75/20 rate, or the applicable federal rate, if you will, that is relevant only for purposes of calculating the net present value of the remainder interest. If, in fact, in the real world, interest rates go up and stock yields go up during the term of this unitrust, then yes, there's an expectation that the annual payments to the donor will go up and up and up and up. So there, I don't know if we're going to get to that one hypothetical question, but so I said earlier that with these very low assumed interest rates, the net present value of the remainder interest is very low. One of the hyper-technical rules for a qualified charitable remainder trust is that at the time that it's funded, the net present value of that down the road charitable remainder interest must be at least 10%. Well, the lower these calculated remainder interests are, the harder it is to meet that requirement. Until a few years ago, virtually anybody could create a charitable remainder unitrust for the lifetime beneficiary, for the lifetime benefit of anybody, a 10-year-old. Well, with these low rates, that doesn't cut it anymore. And I ran a calculation today. So my kids are 34 and 31. If I wanted to create a 5% charitable remainder unitrust for my kids, 34 and 31, I could not, because the remainder, the calculated remainder interest is less than 10%, which is astounding to me. I didn't really fully appreciate that it was even mathematically possible for rates to go so low that that wouldn't qualify. So if I were to create a trust for both of my kids, 34 and 31, it would fail. I could still create a trust for each of them separately, and it would still pass, but barely. So charitable remainder trust can be a powerful life income charitable planning tool, but not as much bang for the buck as there would have been up until the last year or so.
And it could recover. And the other thing too is that they can be made testamentary. I mean, you could put a provision in your will that said, I'm going to set up a testamentary trust for the benefit of.
Yes, you could. And that's a great segue. What else could you do? Well, you could do a stretch IRA. You could do a backdoor stretch IRA. And how do you do that? You could create during your lifetime a charitable remainder unitrust for the benefit of, let's say, your kids, 5%, 7%, whatever it is. You could fund it or not. And then you could provide at your death that your retirement account, your IRA or the retirement account, pours into the charitable remainder trust. So I said earlier that when a beneficiary receives a distribution from an IRA after the death of the owner, the entire distribution is taxable income. That's also the case if the IRA goes into a charitable remainder trust. But guess what? The charitable remainder trust itself is exempt from income tax. So until the Secure Act 2 years ago, it was possible for the owner of a retirement account to designate children as beneficiaries, and the children could take their share and elect to treat that as an inherited IRA and take those required minimum distributions stretched out over their life expectancy. The Secure Act threw all that away as that's way too damn complicated. in favor of a 10-year rule. But 10-year rule basically says that if any non-spouse beneficiary, if there's a non-spouse beneficiary of a retirement account, that beneficiary has 10 years and only 10 years within which to pull all that taxable income out. Well, if in that example, the IRA goes into a tax-exempt charitable remainder trust, the trustee says, I don't care about 10 years. I'm exempt from tax. Give me the money. And what does the trust say? The trust says to make the stated percentage unitrust amount distribution to the beneficiaries over the whole term of the trust. So there, what have you done? You've taken the 10-year limitation in the Secure Act and you stretched it out through the back door, which is a great strategy.
I love those. It says, would you not use IRA funds for a unitrust or an annuity trust?
Yes, I would. Yeah, much, much more so now after the changes in the Secure Act, because until the Secure Act, so I've got 3 kids. I designate them as the beneficiary of my IRA. Each of my kids could take their 1/3 share and elect to treat it as an inherited IRA and take required minimum distributions over their life expectancy at my death, however long that was. Secure Act smushed that into 10 years.
What about using IRA distributions, your mandatory distribution to fund a trust?
Yeah, you could do that, but I mean, that's just math. I mean, basically, this is a case where the donor, I'm just thinking off the top of my bald head here, but that's just a case where the donor would take a big hunk of ordinary income and fund a charitable remainder trust, getting an upfront deduction equal only to the net fair market value of the remainder interest. Does that fit? I don't know. I've never been a fan of funding a charitable remainder trust or any charitable gift with cash. Cash is good, right? We can count it, we can see it, I can value it, but not a whole lot of glamour when you give it to charity. Give charity assets that are a little more piggish for regular people, but great for charity.
Appreciated securities, real property.
Closely held business interests, commercial real estate, patents, you bet. So charitable remainder trusts are one of the very limited number of life income charitable gifts permitted under the tax code, where the donor gets an upfront deduction and retains benefits of some kind. Another one is the charitable gift annuity. The charitable gift annuity is nothing more than an annuity contract between a donor and a charity, under which the donor transfers some kind of asset, cash, marketable securities, or whatever, to the charity. And then the charity, based upon the life expectancy of the donor, agrees to pay a life annuity. Now, that's a contract of the charity. It is backed by the full faith and credit of the charity, unlike a charitable remainder trust, where only the trust is involved. The rates are set based upon recommended rates from the American Council of Gift Annuities, ACGA. And those rates are changed every year based on yields and mortality rates with an intent of preserving a 50% residuum, which is to say, if I transfer an asset to charity of the $100,000 in exchange for a gift annuity, if the yield on assets is exactly right and I croak exactly when I'm supposed to, half of that should be left for charity. They're very, very simple. They're effective. The buyer of the annuity in that example can retain an annuity for the donor and the spouse, for designated people.
How many people can benefit from an annuity? How many beneficiaries can you have with an annuity?
I don't know if that's a trick question. Is there a limit that I don't know about?
I think there's a limit. I think it's 2.
Okay, there you go. There, 2. You know these rules better than I. 2.
No.
But now I'm going to get you with one. So a lot of charitable organizations have very strict rules on what kind of assets they'll take. So again, if a charity enters into a charitable gift annuity agreement, that's a contractual obligation to pay those annual annuities to the beneficiaries for the term of the obligation, even if they live way beyond the life expectancy, and even if the investment yield on the assets received by the charity are very low. So that reserve can go away. It's a huge, huge, huge problem. So because of that, a lot of organizations tend to be very conservative, and they will only consider accepting cash or publicly traded stock if they're going to issue annuity, which is to say no real property, no whatever. But all worthy, smart, nimble organizations, including Willamette, have exceptions to the rules. And I happen to know that Willamette entered into a very large gift annuity contract with a donor who transferred a minority interest in a limited liability company holding a highly appreciated piece of real property subject to a large mortgage. And it worked great.
Can this be done through a will or trust as well? Can you fund an annuity for the benefit of somebody?
You can. You can. There's no authority in the tax code, but I believe you can. It's a little odd because it's not really a gift. It's more of a direction to the fiduciary to tell the fiduciary to go out and purchase a gift annuity from this institution, providing as follows. So it's not really a gift so much as a purchase. But yes, you can definitely accomplish a gift annuity through a will or trust.
And what kind of tax ramifications would that have for the recipient?
Well, I don't want to get lost in the weeds with all of the various rules, but it is fair to say that the income tax effect of distributions from a charitable gift annuity to the annuitant tend to be better than the income tax impact of distributions from charitable remainder trusts, broad brushstrokes. And that's because under the annuity rules, when the annuitant receives a distribution, a payment, some portion of that is return of principal, return of basis. It is very common in the case of charitable remainder trusts, at least during the early years of the trust, for distributions to be entirely taxable to the beneficiary as ordinary income or capital gain. Not the case with charitable gift annuities.
I just want to back up a little bit too, just to point out that there are a couple other differences with trusts and annuities. With a charitable trust, you can make additions to it. A donor could fund it with an asset in 1 year and a couple years down the line, add something to it. We don't do that with annuities.
That is true for a charitable remainder unitrust. Additions cannot be made to charitable remainder. Did I say average? Additions can be made to charitable remainder unitrust, but not charitable remainder annuity trusts.
Okay. No annuities. Yes.
And if the buyer of a charitable gift annuity wants to add to it, it takes a new contract.
Let's see. Well, I was going to have you talk a little bit more about the tax laws.
It's mainly the Secure Act and the CARES Act. And I'm not going to be a policy pundit here on any of these. The Secure Act had some good changes, some not so good. The CARES Act has a laundry list of some interesting changes, not all of which are of huge consequence. And again, the CARES Act was the post-COVID extraordinary 2020 Tax Relief Act. So one change, let me back up to Charitable Giving 101. So normally a charitable gift is going to be fully deductible based upon the fair market value. The amount that the donor can deduct in the year of the gift is limited. In the case of a gift of cash, it's limited to either 50 or 60% of the donor's adjusted gross income with a 5-year carry forward. So you make a $100,000 gift, that's a $100,000 deduction, but it's deductible in the year of gift only up to 50 or 60% of AGI, depending on the circumstances. Any excess can be carried forward. That's the general rule. For a gift of an appreciated asset, that limitation is 30% of adjusted gross income, again with the carry forward. One of the changes in the CARE Act is for 2020 only, for a gift of cash or the purchase of a charitable gift annuity for cash, the amount of the deduction is deductible up to 100% of the donor's AGI, which can be significant. There's also a much smaller little rule that basically allows non-itemizers to take an above-the-line deduction for gifts of cash up to $300. But the big one is for gifts of cash in 2020, the limitation is 100% of AGI. This actually presents an opportunity for what I'll call a backdoor QCD. So we talked earlier about the fact that the owner of an IRA who's at least 70 and a half can make a direct transfer from the IRA to charity of up to $100,000, $200,000 if married filing jointly, as a nothing, which is to say the distribution is not taxable, the gift is not deductible, and the gift can be used against the RMD, which, as we discussed earlier, doesn't exist for this year. So what if you have a younger person? So under the normal rules, the owner of a retirement account may take distributions anytime after age 59 and a half without any kind of a penalty. So what if you have, let's assume you have a wonderful philanthropic high net worth donor, age 59 and a half to 70 and a half with a big old retirement account. Well, this year under the CARES Act, a gift of cash is deductible up to 100% of AGI. As I said earlier, the problem in the past is that if a person takes a withdrawal, a normal withdrawal, taxable withdrawal out of a retirement account and gives it to charity, at best it's a wash. Well, with 100% of AGI, it is a wash. And so somebody between 59 and a half and 70 and a half who cannot make a normal QCD can just make a plain old withdrawal of cash, turn around to give the cash to charity, and it's a wash. No net or phantom taxable income. So that is actually a great opportunity.
Can you talk about the kinds of things people should think about before they meet with their advisor? Like things like, what do we want to give our kids? What do we want to give to charity? That kind of thing.
So in my world, if I'm representing a family in terms of trust and estate planning, to the extent they thought and talked about these issues in detail, that's great for me, because then they come to me, I'm the technical guy, and I can take their wishes and goals and figure out how best to mix and match and put them together and get the most bang for the buck, depending on the asset. I am not personally all that good at sitting down with clients on the sort of touchy-feely, squishy issues and helping them set goals. So to the extent they can figure that out in advance, it's great. So back in the old Star Trek days, the lieutenant, whatever, was, make it so number one. My job with my clients is make it so number one. If a client wants to get from A to B, I tell my young associates and my daughter, our job is to get them from A to B and to do it the most efficient and practical way possible. And if they've figured out kind of what they want to do with charity and kind of what they want to do with kids, then I'm in a good position to help explore with them the best ways to do that.
Next question. What do you think will be the most significant potential change regarding gifting with the new administration?
I think the most significant potential change is if there's any way that the Biden administration can do it. There's a huge desire to roll back the gift and estate tax exemption. So again, although that's not hugely relevant for charities, under the gift and estate tax laws, the lifetime exemption can be used for gift or estate tax purposes, which is to say, used against gifts during lifetime, and to the extent it's not used, what's left can be used against the estate tax at death. It's currently $11,560,000. I remember when it was $600,000. It's gone up and up and up and up. Little factoid here. I think the estate tax was first enacted in 1917. The estate tax exemption has never gone down, ever. It's only gone up. And it went up and up and up and up and up and adjusted for inflation. And then 2 years ago, it doubled from 5 something to 11,560. A lot of people on the left, if you will, think that's way too high. I don't express an opinion on that, but it has come way, way, way up, because what that means is with basic planning, a married couple can pass $23 million during lifetime or a death free of gift and estate tax. Maybe that's good, maybe that's bad. But there's a whole lot of Democrats that think it's bad. So I think that's the single most significant change. But as I said, from my world, the biggest change would be, please, please, please don't repeal stepped up basis in favor of carryover basis, because my life will be a nightmare. But then I'll just retire.
Okay, any recommendations for folks in their 30s and 40s looking how to best plan for their estate, especially if they have kids?
What's interesting to me is a whole lot of the clients that I work with, and I'm lucky that we've got some wonderful, wonderful clients. We do some great stuff. And clients will come in at 62 years old, grown-up kids, everyone's fine, and we really never did any estate planning. And so I'm happy to help, but when you really needed to do this is when you were young and broke with little kids. Because if a person in Oregon dies without a will, those assets are distributed under the laws of intestate distribution based on presumed intent. And if it's a first marriage, those laws say everything to spouse if living, otherwise to the kids. And that's, in 95% of the way, that's fine. But in the case of a young family with little kids, what does that mean? Well, mom and dad are in a car crash. You have 3 little kids inheriting. Little kids can't inherit. So if money goes to minors, somebody has to go to court, get appointed as conservator. Conservatorships are expensive and just to be avoided. So the folks, in my view, that need an estate plan the most are young people with little kids, even if they don't have any money. Now, it is fair to say that in my practice, my bread and butter clients are going to be older and wealthier than that. But then what we're doing is fine tuning. We're doing tax planning. We're doing strategies to reduce the estate tax because we're not necessarily dealing with those issues. It's still relevant, but for young people, get a basic plan in place. Even if you don't have a big enough estate to do much in the charitable world, get a basic plan in place.
So let me ask you this. How do you feel about the online options that are available for people if you're just making a simple estate plan?
I would just like to say they're getting what they pay for. A basic estate plan is not complicated or expensive in this world. Young couple with a low net worth and a couple little kids, they don't have to come to my firm. They can go to almost anybody and get a basic plan. And in almost every case, I won't say the document will be better than some of those online, but the difference is the online platforms are not necessarily going to know or appreciate the facts that require tweaks.
And I would just say that for anybody looking for an estate planning attorney, there are a lot of Willamette law grads, not as good as Jeff, but a lot actually across the country that we can help connect people with too, if they're looking for somebody. I think with that, we will wrap it up. We are going to send requests for feedback from folks. So that'll come out to you all. We're going to be sending out a brochure that covers a lot of these vehicles a little bit in a little bit of depth for you all. So those, just watch your mail for those. And if you have any questions, don't hesitate to call the gift planning office at Willamette University. And Jeff Thede, thank you so much for your time, especially on your vacation. Thanks, everybody.